My next guest is utilizing an investing strategy called a, quote, opportunistic value approach. Joining me now, we've got Aaron Dunn, co-head of value equity and portfolio manager at Morgan Stanley Investment Management. Aaron, good to have you here with us. So let's start off what exactly opportunistic value approaches are and how other investors can follow your lead there.
Yes, we take an approach, I think, which is extremely relevant in today's market, and that is starting with the businesses we're looking at investing in, leaving the stock aside for a second and saying we want to own good businesses that earn good returns on capital. They allocate capital appropriately. They maintain a proper balance sheet, which does not put equity holders at risk in an economic recession. And also they generate a lot of free cash flow, allowing them to compound value over time. That's the general underlying view of how we look at companies. And so from a value perspective and an opportunistic perspective is we look at that business, we say, okay, where are we on a risk reward basis? Where are we on where we think our downside is relative to an upside? And what causes a dislocation in a stock could be something like we saw in March and April, which is the tariff movement and the tariff volatility in the market. And that's, I think, what really creates a lot of opportunity for us because, good companies were thrown out with bad companies in early April and throughout March. And so that creates a ton of opportunities for us to buy what we would view as really good companies. So what we're looking for is a very strong reward to risk view relative to our downside, but we're looking for good companies to invest in. We think that's extremely important today.
Who are some of those companies? Give us an idea, especially of the ones that you're looking across, assessing, and being able to check off all of the items on the list that you just laid out.
Yeah, and I think this is extremely important today. And what you're going to find is what we've had so far is really more technical in nature, and people selling equities because they were probably over allocated. And so what you've seen is the entire market in an indiscriminate manner come down. Now, what I think we're about to see is what are the earnings impact from what happens in the economy. But when you have these periods of sort of uncertainty, investors tend to flock to where companies can still grow. And I think when we do our fundamental work at looking at companies, we want to find companies that are able to grow, not irrespective of the economy, but really with a thesis in mind that allows them to maybe grow earnings through cost cutting or a changing of the business structure at times. So that sounds really interesting to us. So two stocks or three stocks I would mention, one is McDonald's. This company reported last week, and they reported was not a great quarter. The low-end consumer is down; it's very weak, but they are innovating in the menu, and I think that's extremely important. It's a capital-light business model. They don't own the restaurants; they have entrepreneurs that do that. So it's a capital-light business model and maintain a fantastic balance sheet. And with that innovation in the menu, we think they're bringing value back to customers, and we think that you're going to start to see sales really increase.
You say that.
Yeah, go ahead.
So I just want to jump in because you say that the next leg of the market, kind of overall, even as you're assessing some of these opportunistic value names, you say the next leg of the market will be determined more by fundamentals and earnings. And even as you were running through the McDonald's earnings, it really kind of spells out how investors are needing to evaluate fundamentals and the signs that the fundamentals are starting to matter more. What are you seeing there?
So what we've seen is obviously what happened in March, April was there's some, if you look at going into March, April, your earnings estimates for the market were up about, let's call them 12%. You've seen that pull back a couple points, but really what we saw in the drawdown was the earnings multiple really pull back. And I think that also accounts for why we've seen some confidence back into the market and the multiples gone back up. And we closed April about where we started it, really. But what's going to really matter here is the outlook. And so we get a lot of companies reporting earnings the last couple of weeks. We still have a little more left. And you're getting a broad array of how companies are approaching this. Some are pulling guidance completely. I think some are really looking at the direct impact of tariffs on their earnings. And others are saying, we're just not exposed. So we're going to go forward as we are. What I don't think is being contemplated in guidance for companies at this current time is economic performance in the back half of the year. I think they're looking at it and saying direct tariff impact is X amount. That's what I'm going to give you. And that's a 2Q impact. But what I don't think we have yet is what the back half of the year looks like from an economic performance perspective. Now, you had Chris Verona on recently, and I know, Chris, and we were talking about how there's really this market's very negative, but in our view, there's a lot of things that can actually go right. And it was just out a few minutes ago that there's a lot of negotiations going on tariffs. We think we're set up for probably more incrementally positive news on that front in terms of deals. I'm not saying they're going away. I just say incrementally positive. We're coming off the top. And then also this tax bill that's about to start coming out this summer. We think there's going to be some incremental incentives there for companies. We need to rebuild confidence from the executive suites of U.S. companies. Once we do that, we think there's a lot of opportunity here to grow earnings. But and also employment. That's going to really be the big driver here. We need employment to stay strong. It's weakened on the margin, but it still remains in a pretty good spot. If we can keep employment where it is, we think the economy is in a good position. Otherwise, we see a lot of risks to the economy from here.
Yeah, we got some news on the employment front last week. Of course, a barrage of information within that realm of the economic kind of mind frame here. And yeah, holding up and a little bit better than expected, but those expectations were already pretty low. Aaron, we got to leave the conversation there. We'd love to check back in, see how some of these opportunistic value plays are working out. Thanks so much for joining us.
Thanks, Brian.